Hi everyone, my name is Mohammed Khalil Hood, and in this presentation I'll be talking about market bubbles, what they are, how they form, and why they eventually burst. We often see headlines about stocks, crypto, or housing being in a bubble, but many people don't really understand what that means. So in this presentation, I'm going to walk you through in the most clear and simple way. To begin with, I'll cover four main parts: what market bubbles are, how market bubbles form, and a real world example, and finally, what lessons can we learn from these bubbles? Well, a market bubble happens when the price of an asset rises far above its real fundamental value. This usually doesn't happen slowly or logically, instead, it's driven by excitement, hype, and speculation. People start buying things like they don't actually see prices will keep or they're gonna go up. Not because the asset actually worth that much. Well, at some point, this growth becomes unsustainable. Prices can't keep rising forever when confidence finally breaks. Then the bubble bursts, meaning price fall very quick, often in a crash. So in short, price rise too far, too fast, they disconnect from reality, and eventually they collapse back to the more realistic level. Well, most bubbles share a few common characteristics: hype and media attention. There is like a lot of noise, news, and social media talk pushing the asset. And then you have rapid price increase. Prices rise much faster than the underlying value of the profit. But you have another thing called the speculation and herd behavior. People start buying just because other people are buying, not because they understand the asset. And then you have the disconnect from fundamentals. The price no longer makes sense based on the earning, cash flow, or real utility. And finally, you have a high risk and a sudden collapse. So when you see all these together, it's like a strong sign that the market might be in a bubble territory. Going to the real world example, there is something called the dot-com bubble. Let's take a look at the famous example. The dot-com bubble in the late 90s and the early 2000s. During this period, there was like a lot of huge wave of excitement around the internet companies. Like many of these businesses had a little or no profit. In some cases, not even a clear business model. However, investors were extremely optimistic about the future of the internet. Media and storytelling pushed the tech stocks higher and higher. Stock prices rose like far beyond what companies were actually earning. Like around the year 2000, confidence suddenly dropped. Investors realized that many of these companies were overvalued, not sustainable. A massive sell began, and the Nasdaq index fell almost by 80%, causing a huge loss for many people. This is a really classic bubble pattern, like hype, overvaluation, and then a brutal correction. We're gonna move now to why do market bubbles form? Why do market bubbles form in the first place? Here we have expectation of rising prices, fear of missing out, FOMO, and then easy access to credits, media hype, and herd behavior. Together, all these factors create a feedback loop. Rising prices attract more buyers, which push like prices even higher and higher. Moving on to the psychology behind these market bubbles. Underneath of all the human psychology, when the prices go up, investors often become overconfident. They start to believe this time is different, or the asset can go even higher. People follow the crowd. Then the FOMO kicks, and when they enter the trade, not because it's a good investment, but because they are scared of being left behind. We have now the positive news. Success stories and media hype add more fuel. So, market bubbles are not just financial events, like they are psychological events. I'm gonna move now to warning signs of market bubbles. Like when you see this type of signs, it might be some warnings so you can help spot a bubble. Price rise extremely fast without a solid explanation based on fundamentals. Investors ignore negative news or risks, and there is like a very high trading volume. Many of these unexpected investors are suddenly rushing up, and then the asset price become completely disconnected from the real world economic value. When you start seeing all of these at the same time, it's a good moment to be careful. And the question is, what really driving the price? So now I'm gonna move to a slide which is how market bubbles burst. So how do bubbles actually burst? Like at some point price stop rising, maybe because bad news hits, or as simple because they've gone too high. Demand slows down, and some early investors start talking about profit. Other investors notice that this is beginning to worry. Confidence drop, fear replaces excitement. So then selling accelerates. We get a kind of chain reaction as price fall. More people panic and sell. So and then we have latings called the late investors. Those who bought near the top usually suffer the biggest loss. Eventually, the asset falls back and then the level gets closer and closer and closer. So then I'm gonna move to the slide, which is summarize of the key lessons. So as I said before, a market bubble is often when a price rises above its real value due to speculation, hype, or emotion behavior. So that's obvious. And bubbles have warning signs. As I said, rapid price growth, media hype, herd behavior, and disconnect from fundamentals. They usually end up in a sharp way, like driven by panic and loss of confidence. To protect ourselves as investors, we can usually focus on fundamentals, be cautious when everyone seems overly optimistic, avoid talking too much depth just in case of vice pricing, and always remember if something looks too good to be true, it's probably understanding how bubble works to help it. Thank you for listening, and I hope I did good. Excuse me for any words that I made a mistake with English, and there were some notes I took a look about, and thank you so much.